Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. In today's video we are going to look at 6 different stocks that are high growth companies. The earnings are expected to grow at least 15% or more every single year. Some of these companies do pay some dividends. Some are very much not speculative but starting up companies, so companies that are still in the early stages. So some of them do not even have EPS or earnings per share. So we are going to look at these 6 different stocks. But before we do that, just want to quickly show you again, next week in terms of earnings, there's not a lot of companies. Okay, you've got Barrick Gold and a couple of other companies, Palantir and so on, reporting, but majority of the big boys have already reported. And I don't own any of the companies that are reporting or the companies that are actually in here. So yeah, we'll see how it goes next week. You got Coinbase, you got Unity, and there's all this Roblox, and it's probably more to do with ARK investment next week. So we'll see what happens. But yeah, so there's not a lot of companies reporting, and we had a just kind of moderate week where the oil companies went down quite a bit, the healthcare companies went down quite a bit, but tech did really well generally. Okay, so yeah, and as you can see, my portfolio is right now 58,000. Okay, 378 pounds, right? It was June, 21st of June, we were down almost 1%, right? Right now we're up, so 6%, well, 12%, or 6,000 pounds, or over 6,000 pounds. So these things do happen. Sometimes you go up, sometimes you go down. And as you can see, companies like Adobe, where I was down almost to 500 pounds, right now I'm only down 82 pounds. Okay, so the stock has actually bounced back nicely. If you look at it just this month, Adobe, companies like Adobe went up like about 15%. So these things do happen. In the next 3 weeks, we might actually go down again. So you just have to be prepared for it. Right, let's get started on looking at this video. But before we do that, can you please, give the video a like right now? Just go and just click that thing, okay? And if you all have not subscribed to the channel yet, please do. What I'm trying to do here is just share my journey and sometimes give you some ideas, okay, some stocks to research and find out a bit more information about, and that is what we're starting today. Right, KLA is one of the companies in my portfolio, is in the semiconductor company, is currently trading $395 per share, EPS of almost 22, and then EPS next year is expected to grow about 23, to 23. Right, market cap of $56 billion, and it has a wide economic moat. The beta is slightly above 1, so it's quite a little bit volatile for my liking. PE in the sector right now I'm talking about technology sector, is 27 right now. According to this website, is actually an 18, right, for PE. Price to free cash flow 28, so it's more or less the same. They do pay nice dividend, okay, 1%, 12 years of growing that, 12% of growing that dividend in the last 5 years. Dividend growth streak 16 years, payout ratio 20%. The payout ratio is very important because that tells us how much of their net income they're actually spending to give us those dividends, okay? And it's definitely safe, so 71%. They have 2.7% free cash flow there. And in the last 5 years, in terms of revenue growth, it was 18%, and in terms of EPS, it was 24%, which is quite nice. Then when you look at the profit margins, more than 32, okay, operating margins 34.5, return on equity 77, almost 78%, and then total return in the last 10 years is 24%, and current ratio we're looking at way above 1. This is really healthy, very, very healthy company. And the next 5 years, they're expecting the earnings to grow about 16%. According to Simply Wall Street, is basically right now undervalued. Their price tag is 437, and we already seen is almost 400 per share right now. According to Morningstar, is fairly valued. 410 is that's their target. According to TipRank, is only about almost 4% upside if you bought this stock right now, and their price target is $398 per share. And according to Yahoo Finance, it is $414. Moderate buy according to TipRank. I'll be honest with you, for me it is a buy, but I would maybe just to wait see what happens. I think September is a very volatile month, okay? Or you can never time the market, but if you own the stock already you know, and you're up quite a bit, maybe just wait for a bit. If you start a new position, it looks fairly undervalued at the moment, fairly valued at the moment according to this. Okay, so that's why it says a moderate buy. Okay, so it's not screaming buy right now. Okay, right. So the final thing we're going to look at is the Sharia compliance side of things. And right now, as you can see, the business activity screen is almost 100%. Interest bearing is about 7%, and the interest bearing security, so that's the debt and this is the security, is almost about 5%. So nothing crazy there, which is nice to know. Okay, right. So the next company we look at is Palo Alto Networks, and this is one of the cybersecurity companies. They are a relatively new company. Okay, they currently trading $501 per share. They don't have any earnings yet. Okay, so like I said, they are still in the growth side of things. They are growing their earnings and things like that, but they are still basically losing money because they're still reinvesting into the company. But EPS next year is expected to be $9.26 per share. So it is going in the positive next year. So right now it's negative, but next year is going to be a positive. Okay, and then it has a market cap of almost $50 billion. It has wide economic moat, and beta is just above 1. Because they don't have any earnings, or we can't really determine the E, so therefore that reason we don't have any of that valuation side of things. Free cash flow, they got $1.6 billion, 5-year growth rate of 25%, and because they don't have EPS, it's still not applicable. Profits, there's none because the company is still losing money. Okay, so they might, after they start doing this, they might start having some sort of profit margins, and we will see how that goes next year. But none of that exists right now apart from the total return, and that is the price appreciation, the stock price. Okay, current ratio, that's about 25%. The current ratio is just below 1, so that tells me the company might be in trouble in terms of paying off their current liabilities in the next 12 months. But one of the reasons I included this stock here is the next 5 years growth. In terms of the earnings growth for the next 5 years, we're expecting 27.4 every single year. All right, Simply Wall Street is actually gone crazy. They say 60% undervalued, $1,256 per share. That's their expectation. But Morningstar, again, same thing, fairly valued as always. Okay, a little bit more conservative if you like, $590 per share, and tip ranks 26% undervalued at the moment, or upside, and $634 per share. Same more or less when it comes to Yahoo Finance, $633, and it's a strong buy according to tip ranks right now. Maybe it's because of that growth. Okay, a lot of people will actually buy this stock because of the expectation and that growth. Right, so let's quickly look at Sharia compliance side of things, and that is 90, almost 100%, 7% in interest-bearing debt, and interest-bearing security is only 7% as well. So yeah, great company. Normally, tech companies do not have basically a lot of debt, unless we're talking about the legacy companies, like the not Cisco, I think Oracle has quite a bit of debt, and IBM and companies like that. The newer companies don't actually have much of a debt. The next company is MasterCard, and MasterCard, as you know, they don't deal with anything to do with the basically interest side of things, if that's what you're worried about, because a lot of you have asked me recently, how is it compliant? This company is a technology company. They develop the technologies that are used in the cards. They don't care what the companies do with the cards. They actually just develop the technologies that allows these transactions to take place. Okay, currently trading $357 per share. EPS is about almost $10. Next year they will be about $12.64, and market cap of $343 billion. It's a huge company. It has a wide economic moat, and beta is actually quite nice for the company like this. The the PE is quite high, and it always is. Okay, even though the sector is 27, their PE is 36, and it's always the same. Okay, it used to be in the 50s and now come down a little bit, but it is still quite high. Price to free cash flow, you're looking at again 43. Price to sales 16. Okay, now annual dividend yield just 0.55, and when you look at 5-year growth rate, about 18%. So they are growing it nicely, but it's very small. And then they have increased this dividend for 15 years. The payout is very slow. Dividend safety is actually quite nice. $99, that's the highest you can get, and they have a $9 billion in the bank as a free cash flow that they can do with a lot of things. So free cash flow is money that they can pay us as dividends. They buy back their shares, they pay off debt, they acquire other companies. They can do a lot of things with that money. Okay, 5-year growth rate, revenue growth, we're talking about 12%, and then the EPS grew 19% in the last 5 years. Profit margin is absolutely amazing, 55% of operating margins. Return on equity 142, and the last 10 years we're looking at about almost 24% total returns from this company. Current ratio basically above 1, which is what we're looking for. And one of the reasons I've included this in this video is this: 23% growth every single year in the next 5 years. Simply Wall Street is actually, that's very high. That's honestly, let me not skip that. That's very, for a company that has been around for a while, that is very, very healthy. Okay, and again, remember, these are the expectations from the analyst. What they do is they look at the company, where it's been, and basically they look at their value, the intrinsic value side of things, and then they come up with these. So they could look at their revenue growth in the last few years and their earnings and the expectations of what the company has said and what's possible, and they come up with this kind of the expected growth in the next 5 years. They might meet or they might beat that, but that's basically what they're expecting right now. So sometimes when you look at this, you don't just take this as it is. You have to be a little bit skeptical. Sometimes they can miss earnings, all right? So this is not always going to be 23. So it might be lower than that or it might be higher than that. Simply Wall Street right now is saying is 22% undervalued, fair valued of $456 per share. Morningstar is also saying is about $369 per share. They're fairly valued at the moment. A tip rank 16% upside, 413. Yahoo Analyst 418, and is a strong buy according to tip rank. So again, it's a great company. Honestly, it's one of the best out there. It's right now seems fairly valued at the moment, but I don't like the PE. The PE is very high and has always been high. I'll be honest with you. I was buying when it was in the 50s. I'll be honest. And in terms of Sharia compliant, no issues there. Business activity almost 100%. Interest bearing debt 4% and 2% of interest-bearing securities. So no issues there, nothing to worry about. The next company we're looking at is one of the companies that one of the community members have asked me to look into, and that's CrowdStrike. This is a company that I used to own. I've actually sold it, bought it back, sold it again. It made it quite a bit of nice money. But yeah, I really like this company. I like their business model. It's a great company. It's one of the best when it comes to providing cloud protection side of things, okay, cybersecurity side of things, and it's still growing massively. So I think this is going to be one of the best companies in that sector in the next 5 to 10 years. Currently trading $191 per share. EPS is non-existent at the moment. The company is still losing money, but next year they're expecting to start having positive earnings. Their market cap is $444 billion. It has a narrow economic moat, and beta is actually slightly above 1. Okay, there's no PE, so there's obviously there's no earnings for that matter, and price to free cash flow it doesn't exist right now, but they do have some cash right now. Okay, 480 million, which is very nice, because right now I'll be worried if they didn't have a cash in hand, because in order to grow this type of business, they need to reinvest some cash. Okay, and if they could generating free cash flow, then that means they can reinvest that money instead of going to the bank and borrowing money, because remember, the interest rate are going up. When that happens, these companies actually get into trouble, because they will be getting a loan for for very high interest rates, and they don't want to do that because the interest rate will eat into their earnings and so on. So they don't like that. This is why these companies were very much booming when it came to when we had zero interest rate, because they can go to the bank and actually not have to just pay back what they basically took instead of paying any interest. So next 3 years, okay, only for the 3 years, because this company has not been around for a while, we're looking at the revenue growth almost to 80%, and EPS obviously there hasn't they doesn't have any EPS yet. Profit margins and all of these things is not going to be existent because we still don't have a positive earnings. But when you look at the return, total return in the last 3 years, only for 3 years, is almost 29%, which is really nice, and that's price appreciation. Current ratio 1.80, so that means it's really good. So they don't have nothing to worry about in terms of debt side of things. So next 12 months they can pay off their current liabilities if they need to, which is really nice. One of the reasons I've included this company, it was obviously one of the community members have asked me to do this and to look into it, but at the same time is look at this growth. According to Yahoo analysts, they are saying 73% every single year for the next 5 years. I don't know if that's sustainable, but I wouldn't be surprised. The way the world is going on with all these cyber problems that we're having right now with Russia, with China, with Taiwan, all of these things that are happening, I wouldn't be surprised if this continues to, basically get, maybe even if it gets half of that, it's still a high growth stock. According to Simply Wall Street, they're saying 44% undervalued at the moment, fair valued $339 per share. Morningstar fairly valued 196. What is it right now? 191. So fairly valued at the moment. So tip rank 21% almost upside, and 229. I think that's kind of fair. 239 according to Yahoo Finance. I will say in the 200 is okay, and a strong buy according to this. A lot of people will put a lot of money into this company simply for this. Even if you end up getting half of that, that's absolute, that beats the market basically, and this is a market beating company. But obviously you could lose a lot of money as well, because these are still high growth companies, and if they don't get the cash, if they miss one of their earnings, things don't work out, blah, blah. There's so many things. There's a bit of a risk involved. So if you're willing to take that risk, then it is really a good company to own. And finally, what we need to look at is the Sharia compliance side of things. Is 100% when it comes to activity, business side of things. Interest bearing is 1%, debt side of things, and then securities is only 4%, which is really good. So nothing to worry about. Is a very high growth company, very volatile. But if you are willing to just buy and forget it for the next 5 to 10 years, I'm sure you will make some good money. That 73%, that is very, very high. So the next one is another company that one of the brothers have asked me to look into. This company, I didn't know much about it, but it looks like it's also in the cloud software side of infrastructure things. They do a lot of that stuff. So yeah, I didn't even know much about this company. I did a little bit of research, found out they do have a wide economic moat. So they must have some really, in terms of cloud side of things, they must have a really good platforms. As you can see right now, they're trading $45 per share. EPS is non-existent at the moment, but next year they are apparently expected to be the positive, which is really good. Market cap only $4.5 billion. It's a very small company if you think about it. Beta, I couldn't find the beta, so just left it out. P doesn't exist. Price to free cash flow doesn't exist. They have a free cash flow of 33 million, which is really nice. And in the last 3 years, actually, they've grown this business 28%. In terms of their revenue. Profit margins, like I've said, all of that does not exist. And a year, for 1 year, so total return for 1 year only, because that's the only thing I could find, you've actually losing some money. So I think it went up quite high and then maybe it went back down. It's probably one of those beaten down companies right now. So you would have lost about 24%. But current ratio, that's crazy. So they have almost, maybe they have a zero debt. Current ratio is absolutely perfect. But this is one of the reasons probably one of the community members asked me to look into this company, because look at this, almost a 59% growth in each year for the next 5 years. And according to Simply Wall Street, is actually 22% undervalued. The price target is 55. Yahoo Finance and Morningstar is saying 23% discounted. Their price is 58, so more or less the same. According to Tip Rank, is more or less exactly the same. So 56 and 56, these two, and it has 26 to almost 27% upside, and it's a moderate buy. So just for that reason, and the fact it has a wide economic moat, and the fact that it's actually going to have a positive earnings the next few years, you just need to do a little bit more research, find out the company itself and what other companies do they work with. Okay, so because that's really important, because if they are working with some of the, like say Forbes 100 companies, whatever, at least then you know. Like for example, CrowdStrike has some of their customers include some of the biggest banks and so on in the world, so you know that those companies will still want that protection. So if you can find out who they work with, and if they have a wide economic moat, that means they obviously have competitive advantage, and find out what that exactly is. That will be really then good investment if you know the company itself and the software they provide and so on. Okay, right, the final company, in fact, before we move on from then, before I forget, it's 100% in terms of business activity, 24% almost in terms of interest bearing debt, so that's quite high. That can change very quickly. Okay, interest bearing securities 25%, so yeah, that's a little bit high. I'm not sure if I will touch it from that side of things, but hey, that's the information that I got from Zoya, according to Zoya. So the final company that we're looking at in Expedia Group, this is when it comes to online travel company, and currently trading $102 per share. Their EPS, they have a positive EPS, okay, $1.25. Next year they're growing to grow that almost $9.56, so that's massive. Okay, market cap right now we're looking about 16% and $16 billion, and it has a wide economic moat, and beta is actually quite volatile if you think about it. PE is very, very high because they consume discretionary. Consumer discretionary right now is about 23%, 23, sorry, and right now, and then when you look at the PE here is 8 to 1. That's very, very high. Price to free cash flow 4, and the free cash flow right now is almost $4 billion, which is nice. So they've got about $4 billion in the bank right now. 5-year in terms of revenue growth, it was in the negative, which is very weird, okay, for a company like this. And 5-year EPS growth is only about just 5%. Okay, so there's nothing to scream about when it comes to that. Profit margin 2%, operating margins, okay, just 9%. Return on equity, yeah, decent. Okay, total return in the last 10 years, so we're looking about almost 7%, and the current ratio just below 1, which is basically the fact that they got $4 billion almost. I wouldn't worry too much about it. I'm sure they will cover. One of the reasons I've included this company in this is this here. Okay, almost a 23% growth every single year. According to Simply Wall Street, is 62% undervalued. Fair valued is $269 per share. Morningstar 42% discounted. Okay, fair value 175. Tip rank is saying almost 40% upside, as their price target is 143, and 163 is Yahoo's, and according to Tip ranks is actually saying moderate buy right now. So another great company. There's a little bit, I wouldn't, yeah, in terms of the growth in the last few years is not great, but the fact that they're growing, hopefully grow their revenue, their earnings in the next 5 years, each year about 23%. That's very, very high, and that's very healthy. Okay, and finally, in terms of compliance side of it, almost 100%, 26% in terms of interest bearing debt, and 26% when it comes to securities as well. So that's quite high for me as well. So yeah, this is, I'll be honest with you, I will not invest in this company at all. I want to include this because it's a very high growth, and just to show you what else is out there. So those are the 6 companies that I wanted to share with you guys today. If you liked the video and you're still here, please give the videos a like. Let me know if you have any questions. Let me know if you have any companies that you would like me to look into more, and inshallah in the next few weeks or months, whatever. Then have a wonderful day. Assalamu Alaikum.